How are you seeing the macro? You said to me earlier that you think this current period reminds you more of the dot com bubble and subsequent crash than it does the 2008 great financial crisis. Why do you say that? And then also, you have this idea of financial assets as levers that I think is also really important.
I would say this in 2008, you had a lot more banking leverage, right? And so when that bubble burst, you had major credit problems. The dot com bubble was much more of an overvaluation sort of in the equity markets, and so the thing that one of the things that reminds me most of the dot com bubble is this bubble that we have in crypto, where in around the 1999 2000 timeframe, you had all these B2B and B2B companies like Ariba and Commerce One. Most of you guys haven't even heard of these companies. You had also the fiber optic companies like JDS Uniphase. Jim Cramer I'll always remember Jim Cramer used to call JDS Uniphase, the ticker was JDSU, just don't sell us. Famous last words. So all of these companies were bubble companies trading at crazy revenue multiples. And they floated very low floats. Their valuations made no sense, but they were justified by all this new paradigm talk about Metcalfe's law, S-curve adoption, network effects. Any of this sounding familiar yet? So back then, one of the biggest bubble blowers was this guy named George Gilder, who, I feel like there are 1,000 George Gilders today, especially in the crypto space, preaching, new paradigms and you're just a boomer, you don't understand how Bitcoin is valued and you don't understand the network effects. You know what? I think I've been around in the capital markets long enough that I can say that the one thing that doesn't ever change about the capital markets is greed and fear, which is why that famous book, Reminiscences of a Stock Operator, was required reading for all analysts that I hired back in the day. So there are lots and lots of anecdotal parallels for why this is like 2000 versus 2008. Here's another big differentiator. In 2000, remember, I was at Canyon from 97 to 2002, building my ConvertArb capital structure arb business. In around 2000, during the time when the bubble crashed, traditional, sort of directional hedge fund strategies, whether they were equity based or credit based, did very poorly, as you would expect, just like now, right?
So just to explain for the audience, directional means you're betting on the price to go one way, normally up. So when the price goes down, you suffer, and they do, as opposed to
Exactly.
arbitrage.
So like even when you talk about equity long short strategies, let's face it, when you've got like a 15-20 year sort of equity bull market, most equity long short strategies are not really equity long short. They're basically closet beta. They're basically closet longs with maybe some index level hedging and maybe some hedging, but usually a very healthy net long component. So that was the case back then too, and a lot of these types of strategies got caught with their pants down. But ConvertArb back then did really well because, number one, the asset class was still relatively nascent and inefficient, but more importantly, equity vol was much higher than credit vol. Let me say that again. Equity vol was much higher than credit vol. So this slide is a slide from, an investor presentation that I gave back in 2010 or 2012, just explaining what a convertible bond looks like. And so what you're looking at here is on the vertical axis, how the convert behaves relative to the horizontal axis, which is where the stock price is. So, and I basically broke it down into 4 sections. On the left, distressed, and then credit sensitive, and then balanced, and then equity sensitive. So in the rightmost three columns, credit sensitive, balance, and equity, if you look at that curved line that represents the convertible price, that's there. What you're seeing is a positive gamma profile, that curvature that kind of is concave up, convex down, right? So that's positive gamma, that the convertible behaves like an option. And so when equity vol is high, you can basically hedge your convert with a short stock position and make money by monetizing the volatility. The problem is when converts go into that very leftmost region, that distressed territory where the convertible bond no longer behaves like an option, but behaves more like a distressed bond, which is much more like a short put on the assets of a company. And so in 2008, right, when I say credit vol became higher than equity vol, I meant that, you know, in a lot of because of the credit metastasis from Lehman Brothers spreading to all sorts of credit markets, there were most convertible bonds, their underlying bond floors did not hold. And so if you were a convertible arbitrageur banking on the convert being like more of like an option and being able to arbitrage the stock against it, you're out of luck, because more often than not, your bond prices dropped much more than the underlying equity prices, which, you know, it doesn't really make sense if you think about it from a liquidation perspective, because, you know, bonds always rank senior to the equity, right? But you had all sorts of crazy capital structure dislocations like that in 2008 that you did not really have in 2000. And so right now, in this current environment, even though you have some storied credits like MicroStrategy, for instance, and some of their bonds we can talk about are definitely in that distressed category, for the most part, you're not seeing a major sort of credit meltdown like we did in 2008. So that's what I mean by the current environment being more like the dot-com bubble versus 2008 from that one perspective. What's different though, because as Mark Twain said, history might not repeat itself, but it often rhymes. This particular cycle is complicated further by the fact that not only do we have insane bubble valuations, not just in equities, but also in crypto and real estate and all sorts of assets. But on top of that, we've got a very, very strong dollar reminiscent of that 1997-98 period. And we've also got an energy crisis and a stagflationary environment representative of the 70s. And then on top of that, we've now got the complications of geopolitical escalation with Russia-Ukraine situation possibly escalating. I think it's going to escalate into something more serious.